Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital Management. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
Hello, everyone, and welcome to Credit Events, which is a new webcast series that we're developing here at Destra Capital for 2025. In Credit Events, we're going to interview an awful lot of our investment partners that we work with here at Destra, and we're very excited to have as our first guest Eric Chadwick, who is President of Flaherty Crumrine out in Pasadena, California. And he's also portfolio manager on a number of products, both closed-end and open-end funds, as well as institutional accounts. Flaherty and Crumrine invests specifically in preferred and other capital security type investments. And I think that's a great category to get 2025 started with, and to hear from Eric about what he and his firm see as opportunities and the dynamics that the preferred market is facing here in 2025. So Eric, welcome to Credit Events. We're excited to have you with us.
Thanks, Rob. I'm excited to be here.
Eric, I guess, we've talked with you a lot over the years at Destra, as Flaherty's been our longest partner, frankly, since our firm was founded. And you've explained to us that the preferred market space is predominantly created by financial organizations. I'd ask that maybe you can define that a little bit more for listeners here on the webcast. And then if that's the case, what's the outlook for financials in 2025 if they're such a dominant part of creating the preferred market space?
Yeah, Rob, you're absolutely right. Financials have long been kind of the foundation of the preferred market, primarily because banks and insurance companies in particular, other finance companies, are all subject to regulatory capital requirements. And really what that boils down to is they're required to hold a certain type of instrument on the balance sheet, obviously common equity at the bottom, but moving up from there, there's a layer, if you will, of preferred stock and then subordinated debt and on up into senior debt. So it's really a function of the balance sheet and the regulatory requirements to hold certain levels of capital and in different types of products. So preferreds have long satisfied that layer, if you will. About 1.5% to 2% of risk-weighted assets is kind of the way regulators look at it today in today's regulatory environment. And most companies are pretty strongly incentivized to maximize that layer because, of course, issuing preferreds and senior debt is cheaper than issuing more common stock. So if you assume common stock is the most expensive to issue, they're happy to fill the layers above that to meet those regulatory requirements. So that's why banks in particular, the preferred layer is pretty much only comprised of non-cumulative perpetual preferred stock. It's a very traditional instrument. It goes back decades, right? From a legal standpoint, it's just very plain vanilla, which is kind of interesting in today's market where we still see much innovation in investment products. But it's pretty straightforward and has been used in the regulatory side for a long time. With that said, it's been an interesting several years for the financial markets, notably banks. If you go back to 5 years ago, we were still in a very low interest rate environment. That was had an impact on earnings for both banks and insurance companies, et cetera. We saw 21, 22, 23, where we saw the Fed raising interest rates, really had an impact on net interest margins at financial institutions, et cetera. And of course, just fixed income in general really struggled a little bit with higher interest rates. And in 2023, of course, had the specific focus on regional banks and notably around mark-to-market losses. And that's why I mentioned the rise in interest rates, because that's really what was behind those mark-to-market losses. As it turns out, and we felt very strongly at the time, it was very limited to a handful of institutions, kind of very specific issues that those institutions had. But there was a pretty broad sell-off in the space, particularly in the regional and community bank space. And then we really spent the rest of 2023 proving one quarter at a time that bank earnings were pretty solid. And these banks were not only hanging on to their deposits and still making quite a bit of money, but also in a position to navigate and grow as the market recovered. Fast forward that into 2024 and now 2025, we're well into that proof, if you will. Quarter after quarter, we've really seen a very strong recovery in both regional banks and large money center banks have kind of been strong all the way through. But they have very high capital ratios. They've managed their loan losses very well. Of course, CRE has been a topic of discussion, but what we find, again, you start putting some time in there and some earnings reports in there, CRE has been well managed by most institutions. It's not to say there aren't outliers, but as a banking system as a whole, we've managed through these issues quite well. And I think the outlook for 2025 is we're sitting at very high capital ratios, very strong regulatory environment that really hasn't been weakened in quite some time. And so that's very good for preferred holders and really, all the way up the capital structure. So we have a pretty positive outlook for 2025. We're starting to see interest rates come back down on the front end of the curve, which we'll talk about a little bit. But that's helping banks' net interest margin, which is a key component of how banks earn money, right? They're really a spread business. And so what we've seen in the interest rate profile has really helped to soften that and continue to make their earnings, give them a prospect for growing earnings again.
Eric, you referenced this just a moment ago, but if you think about the yield curve, just a few years ago, we were in an inverted yield curve, which is an odd experience for fixed income investors. It only happens a few times in history, but it was pretty persistent for a few years. But then in 2024, with the Fed actions, we sort of saw normalization of that yield curve. What's the implications for preferreds with that?
Yeah, Rob, this was one of the longest yield curve inversions we've seen. And there are real implications for that. If you kind of take a step back and think about just risk profile, if investors can buy T-bills on the short end of the curve at higher yields than they can invest by going out the curve into, let's say, 5-year, 10-year perpetual in the case of preferreds, there's great competition, right, for those dollars. And so you're earning a relatively high yield without taking a whole lot of risk, certainly duration risk or credit risk, right? You can own the U.S. Treasury market. Of course, that's a short-term trade, generally speaking, and even in this case, a year-and-a-half trade, but still relatively short. And at some point, investors have to make the decision as the front end of the curve comes down with Fed interest rate cuts, you have to make that decision about whether you're willing to move out the curve to keep the income that you're kind of used to receiving. So that's really, you want the curve to normalize so that going out the curve, taking duration risk pays you something, right? And there's incentives to if you want to earn higher yields, that you have to essentially go out the curve or go down in credit, of course, but we don't really like that trade as much. So the Fed so far has cut about 100 basis points off of the peak Fed funds rate. And what that has done, in addition to some backup in treasury rates on the intermediate and longer term, we actually now have a positively sloped yield curve. It's still relatively flat, but at least it's not inverted. And so it really comes down to a couple of things. One is the competition factor, of course. Rather than owning money markets, now you got to choose to be an investment if you're in the fixed income space. So you're going to consider investment grade bonds, you're going to consider high yield, you're going to consider preferred stocks. And so preferreds, like other credit product, are going to benefit from investors, needing to replace that income as the yield curve normalizes. And you get back just into a more normal risk profile where you expect a positively sloped yield curve, right? So you're getting paid for going out the curve on a duration basis. So that's what we've seen. Whether the Fed cuts further from here is a little uncertain. They are kind of mostly factoring in 2 more rate cuts by the end of 2025. But of course, there's a lot of macro factors happening at the moment that's put those a little bit on pause. But assuming they do cut another 50 basis points, 225 cuts, that's going to put the front end of the yield curve back below 4%. And that'll have, again, real implications for investors that have been just sitting in short-term money market funds or T-bills. They're going to be facing the facts of lower income in effect.
Can you talk a little bit about the historical sort of enhanced income that people have sought in preferreds?
Yeah, preferreds, generally speaking, it's a pretty straightforward investment thesis, which is you can buy investment grade credits and you can go down the capital structure into a preferred stock as opposed to a senior unsecured bond, and you get paid extra spread for that. We refer to it as the subordination premium. And historically, it has kind of a wide range, but it's been anywhere from 100 to probably 300 basis points, depending on the type of company you're in or maybe the industry. While we talk about financials, there are a couple of other industries that get represented in there. But in general, let's say on average, you're picking up in today 100 to 150 basis points of additional income to go down the capital structure into preferreds. But again, if you're buying investment grade credits, the probability of default is going to be very, very similar between the senior unsecured of that company and the preferred of the same company, right? So that's really the broad thesis. Rather than high yield and going into much more risk from a credit standpoint, where you really do expect credit losses over time, if you stay in the investment grade space, you have basically an IG portfolio, but you get paid the extra yield. It doesn't come for free, of course. If in fact you're wrong on a credit, the loss severity is higher than it would be on a corporate bond of the same issuer. But the idea really is don't take that risk in the first place in any greater amount than what you could do in a normal fixed income portfolio. So that subordination premium is really quite powerful, right? If you assume it's 100 to 150, let's say 200 basis points annualized, right? So every single year, there's going to be a compounding effect on that as well. And it has proven to be a healthy advantage for preferred investors over just traditional fixed income.
Eric, that historical higher potential income has attracted some pretty stable investor bases. In the institutional world, insurance companies have always been a big buyer of preferreds. And on the retail side, preferreds are frankly a core component of a lot of portfolios for retired people or folks that are drawing income off of their portfolios today. And those have been consistent buyers. Do you see more interest in preferreds? Any new potential demand coming into the space?
Yeah, Rob, it's really been an interesting couple of years because we've seen this particularly in the institutional space, where traditional bond managers that typically just own investment grade bonds, right? No bells or whistles, they don't really stray from that. They've really struggled to get enough spread. Corporate bond spreads are near historical tights at this point. High yield spreads are also near historical tights. And the implication of that, of course, is they start looking for additional sources of income. And for all the reasons we just talked about, the subordination premium without taking a lot of credit risk, that trade, in effect, is playing out in the institutional credit space. And so what we're seeing is a lot of, let's say you have what they call a core bond fund, right? That's a very common term, and lots of managers offer that. Core bond funds are buying preferreds and preferred-like instruments, hybrids, for exactly the reason we talked about. They can stay in the investment grade space from a credit standpoint, but they can add a bunch of incremental yield to those portfolios. So a lot of times they call it core plus, if you will, but this really is the plus. It's a plus from a credit standpoint, and it's also a plus from an income standpoint. And it really gives them some flexibility to, kind of live through periods of tight credit spreads on the senior unsecured space. And even though we've seen a tremendous amount of issuance in the senior unsecured space, a lot of it has been refinancing, and it really has resulted in quite tight spreads. Preferreds have tightened also, but not nearly to the extent that IG and high yield have. And so we think that's a really compelling argument, and we're seeing that play out really. We think of it as crossover buying, right? It's non-traditional preferred accounts buying into the preferred and hybrid space for the same reasons that we recommend it for other investors.
Eric, can you talk a little bit about the potential for taxable investors to maybe get a better outcome in preferreds than they might in, say, investment grade corporate?
Yeah, this is a really key component, Rob, of the preferred space, and somewhat unique in that most preferreds, not all, but most preferreds are paying distributions that are tax advantaged in the form of qualified dividend income distributions. So much like an equity, right, a common stock dividend is usually considered QDI or qualified dividend. Most preferreds are also paying QDI eligible dividends. So the key component really is that in many tax advantaged markets, this has been true in the municipal space for years, investors are willing to accept a lower yield in order to take advantage, if you will, of the tax benefit. In the preferred space, what we've seen, and QDI has been around really going all the way back to 2003, in the preferred space, we're not seeing a whole lot of distinction between QDI eligible preferreds and fully taxable preferreds, which basically means you're getting that benefit almost for free. And QDI dividends are taxed at long-term capital gains rates. So ordinary income, corporate bond interest, high yield bond interest, et cetera, or any debt interest really is taxed at ordinary income rates, which of course can be up into the mid 30s. Whereas long-term capital gain rates are generally 20% and below, depending on what your income bracket is. So there's a huge spread there between ordinary income and QDI eligibility that in effect is a gross up of the yields that you talk about in preferreds. So if you can buy a preferred that's, let's say, 6 3/4, the taxable equivalent yield, the grossed up yield is going to be 870 or so, well over the mid 8s. And again, what's really important is you're not paying for it. And that's kind of unique in our space. It has to do really with preferreds being a bit of a niche market to begin with, but it's an advantage that we think investors should definitely be taking advantage of. Oftentimes, investors compare pre-tax to pre-tax yields because it's simple and taxes are complicated. But if they're not paying attention to the after-tax differences between a corporate bond and a preferred, they're really missing a lot of extra income there.
I'd like to close by just asking you to give us a sense for where you think credit in general, not just preferreds, but credit markets all together, but particularly preferreds, where they may have pockets of concern or risk for you in 2025, and what you think that leads to by way of an outlook for them as an asset class.
Rob, what's really interesting, I think, about preferreds is come full circle back to kind of where we started, which is you really think about risk to financials because that's the heavy concentration in that. And what's fascinating about it is we're in a period of macro events that by and large are not that concerning for financials. So the preferred market, as I mentioned, does have other industries, primarily utilities, some energy exposure, of course, some REITs. But other than that, its bulk of it is financial. And so a lot of the risks that we're talking about today, whether it's interest rates, tariffs, all of the macro related things that are going on in the economy, financial institutions in particular are already kind of a couple of years past the issues that were bothering them, right? Not to say they're not taking credit risk. We need a strong economy. Because at the end of the day, they're making loans in their portfolios. We want loan performance to continue to be good, et cetera. And we don't want broad inflation. But broadly speaking, the more industrial side of the economy, or maybe even services side of the economy, where they're not really issuers of preferreds to begin with, is where a lot of these macro factors appear to be hitting. So, I think from a risk standpoint, I don't know if it's a risk as much as just kind of outlook. Rates are still going to have an impact on fixed income credit broadly, right? So the Fed has definitely slowed down their cutting cycle, but it still appears likely that we're cutting rates rather than raising rates. And so that should be also kind of a tailwind, if you will, for fixed income credit markets. And then lastly, I would say this isn't a risk, this is kind of an opportunity, which is the market's been quite technical. And really what I mean by that is the supply-demand picture. We're not seeing a tremendous amount of growth in the economy is doing well, but bank portfolios aren't growing rapidly, right? The economy is chugging along in the 2 to 3% GDP growth range. And really what that means is there's not a lot of extra need for extra issuance of preferred. So a lot of what we're seeing is refinancing today. And on a net basis, we're seeing relatively flat issuance, whereas the demand side, as we've talked about throughout this discussion, has really picked up. So I think that supply demand, I hate to call it an imbalance, but there's definitely a tailwind on the demand side, and the outlook for supply is still very manageable. And so I think that's a really good technical backdrop for the preferred market in particular, but it's also for the broader credit markets. And it's part of the reason we saw so much resiliency in 2024, even though we had a tremendous amount of interest rate volatility. Credit markets were that volatility was dampened significantly by the performance in credit spreads. So we think that outlook probably continues for much of 2025, unless we see some outlier, of course, which always impacts markets. But as we sit here today, we've got a pretty good outlook for the market, and one that's going to continue to benefit from the tailwinds.
Terrific, Eric. Thank you very much. First of all, thanks for being our first guest here on the new webcast Credit Events, and thank you for the insights and wisdom about preferreds and what the market may hold here in 2025. We look forward to having you back again.
My pleasure. Appreciate you inviting me on.
Great. Thanks, everyone. Please tune in again for the next edition of Credit Events.